Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. And today we're actually going to take a look at a losing trade. I always believe it's important not only to examine winners, but also to take a look at losers because we could learn a lot from both. Today's question comes from Kevin. Alan, most of my trades have been winning ones, but I had one go south. I would like to learn from this trade, so I'm hoping you can help me learn how to handle it tactically and emotionally. Here it is. On 12/20/17, I bought 200 shares of GRUB at 73. Then I sold one in the money 72.50 strike for 290 and one deeper in the money 70 call for 425. For the next 3 weeks, the stock hovered between $71 and $74. Then on 1/8/18, it started 3 days of 3 to 4% price declines with no apparent negative news. On January 10th, 2018, the 10% guideline was reached and shares were sold at $67.70. My questions. Did I select the wrong stock to begin with? Did I misinterpret the technical signals? Should I have rolled down instead of selling the stock? And how would you have approached this situation? Many thanks, Kevin. Okay, well, I have to start by saying we all find in our portfolio that there are going to be losing trades. No one's portfolio consists of all winners. That's why this is such a valuable example to take apart and research. All right, let's start by just showing graphically what Kevin's trades look like. You can see on 12/20 that the shares were purchased at 73, and then two in-the-money calls were sold. One at 72.50 for 290, and one at 70 for 425. So both lower than current market value. Stock price moved between 71 and 74 for the first 3 weeks of the contract, which was fantastic for Kevin. But then on January 8th, all of a sudden, for no apparent reason, the price of the stock started to decline. And then finally, 2 days later, on January 10th, the 10% threshold was reached. That's part of our exit strategy arsenal, and where we buy back the short call automatically. And then Kevin decided to sell the shares at $67.70. All right, so let's break down all the questions that Kevin had for me and see if we can make some sense as to whether or not these were managed properly. Let's start with the first two questions. Did I select the wrong stock to begin with? And did I misinterpret the technical signals? Well, the stock was on our premium watch list. That means that we screened it fundamentally, sales and earnings growth. We screened it also through the common sense screens, like avoiding earnings reports, minimum trading volume, etc. And now here's the technical price chart. Now the blue arrow at the top of the screenshot shows when Kevin entered the trade, and you could see that the price bars were above the 20-day exponential moving average and also ascending, well above the 100-day exponential moving average, and confirmed by the momentum indicators below. Now, were there technical signals that Kevin missed during the contract once the trade was entered? Because it became apparent just by looking at the price chart and the fact that our screens already looked at it fundamentally and from a common sense perspective, that it was a good stock to select initially. But were technical signals missed during the course of the contract? Now, the first bearish signal, which I numbered on the screenshot number 1, shows that the MACD histogram, those blue bars, started dipping below the zero line. So that's like a minor bearish signal, a minor red flag. The second bearish signal, highlighted by number 2 on this screenshot, shows that the stochastic oscillator, another momentum indicator, dipped below the 80th percentile for the second time, a double dip, which is an extremely bearish signal. So that was the second bearish signal. And finally, the third one, highlighted by number 3 at the top right of the screenshot, shows that the price of the stock actually started moving below the 20-day exponential moving average. So at that point in time, which is very close to when the 10% threshold was reached, we had all those technical signals in place indicating a bearish situation. So now I'm looking back thinking, would I have noticed this before the threshold was reached? And I have to be honest and say that I don't think I would have. I don't think it would have been brought to my attention where I would have decided to research the price chart again. So I think that at that point in time, even though there were some bearish signals in place, had we studied the chart, being a Monday morning quarterback and looking back from that perspective is much easier than when things are happening in real time. So far, Kevin, I have no problem with anything that you did or didn't do. Okay, let's now move on to the next question that Kevin had, which was, should I have rolled down instead of selling the stock? Now, one of the criteria that I use when making these determinations is how is that stock performing in relationship to the overall market or in relationship to the S&P 500, which is the benchmark that most people use now when they're looking at the overall market. In the screenshot shown in this video right now, you could see that when Kevin entered the trade on the left side of the screenshot, that GRUB was well outperforming the S&P 500, and as we said before, a good stock to consider for short-term option selling. Now, at the time that the trade was exited, when the 10% threshold was reached, you could see that GRUB was underperforming the market by, was down about 5%, a little bit more than 5%, whereas the market itself, the S&P, was up 4%. So there was greater than a 9% discrepancy between the performance of the market and the stock itself. So there was a significant underperformance of the stock in relationship to the overall market. When that happens, most of the time, I would lean to selling rather than rolling down. Had it been a closer situation where the stock was not underperforming the S&P 500, or maybe not at all, then I would more consider rolling down. So once again, Kevin, I have no problem whatsoever with the fact that you decided to sell the stock at that point in time. So far, I'm impressed with the way you managed this trade. All right, let's move on now to the actual math of the trade, because we started by saying that it was a losing trade, and it was. Kevin lost money, but we're all going to have losing trades. So let's break it down and see what we can come up with here, what we could learn. Well, given that the stock was purchased at 73 and sold at 67.70, and the fact that we're dealing with 200 shares, means that the amount that would have been lost had there been no option selling would be 1,060 plus commissions. All right, so if our next door neighbor bought these shares at the same time that we did, but didn't sell options, that's the amount of cash that would have been lost. Now, having sold options, we're going to have a credit, and the total amount of option premium that Kevin generated from the 2 in-the-money calls was $715. So the loss, including commissions, came to a little bit under $400. So in one case, the loss is 1,060 plus commissions, and then in the second case, the loss is less than $400, including commissions. So what are the takeaways here, and what would Alan do? Okay, well, as I said during this video, I have no problem with anything that Kevin did whatsoever. He purchased a stock that appeared to be an elite performer from every perspective, fundamental, common sense, and technical. He waited for that 20%, 10% guideline to be reached. In this case, it was the 10% guideline because it was later in the contract. You may recall for the first 3 weeks, the stock price was staying within a very favorable range. But then all of a sudden it dipped towards the very end. So it was handled appropriately. So the takeaway here is that I would not have done anything differently. I would have managed it exactly as Kevin did. Now, perhaps others might have managed it differently. That doesn't make me or someone else right or wrong. It's just a matter of what your comfort level is and how you approach the strategy from both an entering a trade and exiting a trade perspectives. There will always be losing trades. I mean, you know, some people think that if you do all of the process in the BCI methodology, that you can't have a loser. That's not the case. There will always be losers, but we should have way more winners than losers, and we should understand how to mitigate losses and enhance gains. And if we could learn and master that, then our portfolios are going to grow exponentially and ultimately lead to financial independence. And that becomes part of the third required skill of covered call writing, which is position management. So you have three skills: stock selection, option selection, and then position management. And the major takeaway from Kevin's trade is the following. Option selling reduces cost basis. And when you do that, you're going to mitigate losses. And that's why when we're using covered call writing, our chances for successful trades are enhanced because our cost basis is reduced by the option premium. And that, folks, is why Kevin's question is so critical and important. And I want to thank you so much, Kevin, for giving us the opportunity to use your trades so that we had the forum to create this information for our members. I also want to thank, of course, everybody out there for taking the time to watch this video. I hope you enjoyed it, and most importantly, I hope you benefit from it. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.